We are going to shoot from strength again here today and dig into a little strategy risk category. So Paul, go ahead and bring us into the title slide here. So as a beginner trader, right, this is for my beginner traders. You just got started, you're excited about trading, and you're kind of new to all this and you don't really know where to start. You're going to have to make a lot of, kind of left or right decisions, kind of up or down decisions when it comes to what you decide to do. And one of those is going to be, what type of strategy risk category do you want to engage in? Like, how do you want to get this guy started? Do you want to focus primarily on defined risk, or do you want to focus primarily on undefined risk? And so that's what I want to do for today. We're going to tackle defined risk. Tomorrow, we're going to tackle undefined risk, very much from a bird's eye view, kind of 10,000 foot, vantage point, very zoomed out to give you some things to think about as you're making these decisions. So Paul, go ahead and bring us into the information here today. So defined risk strategies. So some of the more popular ones that we might use here on the Tasty Network are going to be vertical spreads, iron condors, diagonal spreads, calendar spreads. This is not an exhaustive list. There are other defined risk strategies that you could utilize as well, like iron flies would be another one that we might use from time to time, especially for my zero DTE traders that might be out there watching the show. Welcome aboard. I'm glad that you are here. I would say of these strategies, the vertical spread and the iron condor are going to be the two most common and the two most popular. And that makes a lot of sense because a vertical spread, whether it be a long vertical spread or a short vertical spread, once you understand the framework, it's fairly simple. You're taking a directional shot. Your risk is defined. You want to play the stock or the index to the upside. You do a bullish vertical spread. You want to play the stock or the index to the downside. You do a bearish vertical spread. An iron condor, really at the core, is nothing more than two vertical spreads together. It's a vertical spread above the market and a vertical spread below the market. More specifically, it's a short vertical spread above the market and a short vertical spread below the market. So when you start thinking about vertical spreads relative to iron condors, these are two strategies that a lot of traders like to utilize to start off with when it comes to the defined risk category. Okay. How are we going to wrap our minds around defined risk strategies and what it offers to us? Like, how are we going to make some sense, related to, does this seem like a good idea when it comes to the different strategies I might choose or the risk category? Well, there's only one way, guys. There's only one way to break anything like this down. We've got to look at the gimmes and we got to look at the gotchas, because we know that for every gimme, there is indeed a gotcha. So when it comes to defined risk strategies, like, what are the gimmes and the gotchas? Again, I wouldn't necessarily pretend that this is an exhaustive list either, but I do think this is going to really give us a good start to defined risk and what it does indeed offer us. So the gimmes. Number one, your maximum loss is known on entry. This is without question the biggest gimme with any defined risk strategy. Vertical spread, iron condor, calendar spread, diagonal spread, iron fly. It doesn't matter. Across the board, the biggest gimme on the board is your maximum loss is known on entry. So regardless of how bad it gets, like if you totally miss the mark, like you play it to the upside and it crashes, you play it to the downside and it's just a face ripper, like it doesn't matter how badly you might miss the direction on the trade or just get it totally wrong, your maximum loss is known on entry. That's incredibly powerful. That's incredibly powerful and incredibly valuable. So that is without question the biggest gimme. Another gimme is the management with a defined risk strategy is arguably simpler than it is with an undefined risk strategy, which again, we're going to look at those guys tomorrow. So simpler management is a gimme. Now, surprisingly, or maybe not so surprisingly, it also ends up on the gotcha side as potentially being a gotcha, but we'll get to that here in just a second. Maximum loss is known. The management is simpler. I would say these are the two biggest gimmies, with the biggest gimme clearly being the fact that the maximum loss is known. What about the gotchas? Well, number one, you have lower Greek exposure. So what does that even mean? Well, remember, with what we're doing here at Tasty, like we're trying to tap into, some of the Greeks that come out of the Black-Scholes model to give ourselves, some idea of what we're trying to accomplish in the marketplace, whether it be a given delta, whether it be a given theta, whether it be a given vega. We've even looked at delta and theta in these little educational pieces on this very show. So you've seen that over the course of the last few weeks. Well, when it comes to a defined risk strategy, like, a vertical spread, iron condor would be two great examples here. The Greek exposure that you actually have on the strategy is much, 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 much less than it would be with an undefined risk strategy. And so, simply put, you want to put time in your favor. Like, this is something we do all the time on the network. This is something that, as a premium seller, this is arguably your biggest advantage. Well, here's the truth. If you sell a vertical spread, and that's the way that you're going to play time, and that's the way that you are going to position yourself for positive theta, the reality is you have a lot less positive theta than you would if you had chosen an undefined risk strategy. And this is simply because you have that maximum loss. That maximum loss is known. Well, the only way to have a known maximum loss is you have to have a long leg that covers all of your short legs. And so the short legs are going to be the things that build up things like positive theta and negative vega, so playing the volatility contraction in the marketplace. When you then add a long leg to each short leg, you are naturally watering down the Greek exposure that you had from that short leg. So you maybe built up some positive theta from a short call, but because you had to buy a call to pair up with that short call to minimize or to define the risk on the strategy and minimize the risk on the strategy, you are going to be left with less overall theta because you're essentially buying back some of that short theta, some of that positive theta with that long leg. This is a huge gotcha. This is a huge gotcha when it comes to a defined risk strategy. Now, of course, is it as big a gotcha as the gimme is on the other side when it comes to the maximum loss being known? Probably not, but still, it is a significant thing you have to be aware of when it comes to what you're trying to do, how you're trying to make money, how you're trying to move forward with your portfolio. You are going to have much less exposure with the Greeks for defined risk. Also, a big gotcha. You have less flexibility. And so, on the one hand, on the gimme side, we saw simpler management. It's a little bit easier to do. There's not really a lot of like rolling up and down of the strikes. There's not really a lot of like transforming, into a different strategy where, if you do an undefined risk strategy, you may start the strategy with like a short put, but you may end up with an inverted strangle. Like that happens all the time. With a defined risk strategy, that's not usually going to be the case. You're typically going to go in with a vertical spread and come out with a vertical spread. You're typically going to go in with an iron condor and come out with an iron condor most of the time. So the management is a lot simpler. But the flexibility in terms of the different things that you can do is much, much, much limited relative to what you could do with an undefined risk strategy. So this is also a big gotcha, especially when it comes to, at Tasty, inside the Tasty world, if you've been accessing or following our content for any length of time, we've got all kinds of protocols in place. We've got all kinds of sets and mechanics and different things that we do when the market moves against us and the position is not working. Like, what do? Well, when you have a defined risk strategy, the reality is what you can do is far more limited relative to what you could do with an undefined risk strategy. Now, again, some of you out there might be thinking, but Jim, still, that is not nearly as bad, or that is not nearly as good as the gimme on the other side when it comes to my maximum loss being known. And that's totally fair. That's 100% fair. And that's why, to end this piece today, all new traders, if you're brand new, I'm so glad you're here. Welcome aboard. I hope you stick around. My show, the other shows, there's so much amazing content here for you. All new traders should begin with defined risk strategies only. You should be doing defined risk strategies only. It doesn't even matter what your account size is, whether it's 10,000, 20,000, 50,000, whatever, it doesn't matter. You need to gain experience. You need to gain market awareness. And you don't want to do that with a short straddle, an undefined risk strategy. You don't want to do that with a ratio spread, another undefined risk strategy. Those things are coming down the road. Those things are things you can do later on when you've gained experience, when you've built up some market awareness, and you feel a lot more comfortable with how, the market moves and reacts and how that impacts, options and given positions and things like that. You don't necessarily want to start off with that because that's where you have no safety net. That's where you don't have the training wheels on anymore. But with a defined risk strategy, you always know the maximum loss. You always have that safety net in place. That's incredibly, incredibly valuable. So when it comes to choosing your strategy risk level, that is a little bit about defined risk strategies. We are going to continue to shoot from strength here today and dive into undefined risk a little bit. So Ryan, go ahead and bring us into the title slide here. So choosing your risk category, right? It's choosing your strategy risk, I should say, or I guess it could be your risk category. So yesterday we talked about defined risk. So yesterday we talked about how, if you're a new trader, like everybody should begin with defined risk. Like this is a natural starting point for everyone, almost regardless of your account size. Like if you're just getting started in the world of derivatives, everything is new, everything is different. You don't really want to necessarily be diving into the deep end. Well, today we're going to talk about the other side of the fence when it comes to your strategy risk. We're going to talk about undefined risk. So Ryan, go ahead and bring us into the information there. So undefined risk strategies. So I would say, again, this is not an exhaustive list. This is not intended to be all of the undefined risk strategies that are out there, but short puts, short strangles, ratio spreads, and jade lizards. These are probably going to be the 4 most popular undefined risk strategies that we utilize here inside of the Tasty Network. And I would say short puts and short strangles are going to be on the top of that list. I mean, these are probably the 2 undefined risk strategies that many of you out there that have been trading undefined risk strategies, you probably have a couple of these on in your portfolio right now. Like this is the tried and true. These are the plain vanilla. These are very, very classic strategies when it comes to undefined risk. Now, when you move a little further down the road, like when you move a little bit further down the learning curve, you gain some experience and you kind of want something that's a little bit more customizable, if you will. This is when you might do some ratio spreads. This is when you might do some jade lizards. You might even get into some short straddles. I mean, there's other strategies that you could utilize as well, but these are probably going to be the 4 most popular undefined risk strategies that we use here in the Tasty bubble. What are the gimmes? And what are the gotchas? We talked about this yesterday, right? We talked about this with defined risk. I think this is the best way to break down anything in the marketplace. You look at the gimmes and you look at the gotchas. They always come together. You can't have one without the other. So what are the gimmes when it comes to undefined risk? Well, number one, you're going to have a superior pop. Like when you choose undefined risk, when you don't have the long legs that are covering all the shorts, like we talked about yesterday, obviously you don't have a safety net. We're going to talk about that here in just a minute, but you are going to be rewarded with higher probabilities. A short put has a higher probability than a short put spread. A short strangle has a higher probability than an iron condor. And so these are very natural things that you're going to experience when you choose undefined risk strategies over or relative to their defined risk counterparts. Number 2, they are easier to adjust. So when it comes time to manage a position, it comes time to move some things around, undefined risk strategies are indeed easier to adjust. They're easier to roll out. They're easier to adjust the strikes, kind of change the risk parameters, maybe look at ways in bringing in additional credit on the position. With defined risk, you are quite limited in the different things that you can do. Like with defined risk, there isn't really that much that you can do once you put the position on. You're kind of left with kind of a set it and forget it type of situation. Not entirely, but relative to what you can do with undefined risk, it's definitely a very, very different type of strategic category. And so those are your 2 main gimmes. Okay, what about the gotchas? Well, obviously, this is the elephant in the room, right? This is the grand poobah, unlimited risk. It's in the name. I mean, you have an undefined risk strategy. You're selling a put, you're selling a strangle. You are going to be exposed to essentially unlimited risk on both sides of the market. Now, if you're brand new, that probably sounds pretty scary. And it should if you're brand new. Hey, even if you're seasoned, oftentimes that sounds a little scary. We have a wealth of resources in terms of kind of unpacking what that actually looks like for you as a day-to-day trader and on a strategy by strategy basis. And yes, theoretically, you have to understand that when you sell a strangle, you are exposed to theoretically unlimited risk. And so you need to be aware that it is indeed undefined in that regard. But when it comes to the practical risk, when it comes to the worst case scenario that you are most likely going to experience, it's not necessarily a theoretically infinite amount of loss, as we talk about so much here in the archives. I mean, I've done a ton of segments on that very idea. You can Google that yourself and kind of take a look at some of the things I've done in the past in terms of practical risk and what you're actually up against when it comes to an undefined risk position. But it is true that you are indeed exposed to undefined risk. But number 2, the other gotcha that I think is it's more complex. Like now you're engaging with something that's going to be more complex. Now you're engaging with something that's going to have more moving parts. It's going to take more time to follow. It's going to take more investment on your part in terms of, the mental resources. Obviously, the buying power impact is going to be greater. It's just going to require more resources from you to put the strategy on and to monitor the strategy over time. I mean, when you put a strategy on and you have a safety net in place, I mean, that's obviously really, really nice because you know that no matter what happens, this is as bad as it can possibly get. Like no matter what comes next, this is the worst case scenario. That's incredibly valuable, of course. And so when you remove that, there's an added layer or a couple of layers of complexity to the strategy without question. Okay, over time, and this is the main point. If you're just starting out, again, start with defined risk. If you're just starting out, you need to start with verticals. You need to start with iron condors. You need to start with these defined risk strategies. You need to do that for a while, whether it be some number of months, whether it be a full year, whatever. You need to give yourself plenty of time with defined risk strategies. But over time, many traders find that undefined risk strategies actually provide them with more predictable results and more predictable outcomes. I know that sounds kind of crazy, and it even sounds kind of backwards. Like, how could that even be the case if these are going to bounce around more, be more volatile, and not necessarily have that safety net in place? You should absolutely look into, there's so many market measures the team has done, so many options jibes the team has done where they've looked at this very thing, looking at strangles over time, looking at short puts over time, and kind of showing that, when you give enough observations to a given strategy, the results can be quite smooth. The results can be quite predictable over time when it comes to undefined risk positions. So again, just a 10,000 foot view, just a very broad overview of the different strategy risk categories that you could choose, with defined risk relative to undefined risk being the main decision that you have to make. And there's a few thoughts around undefined risk.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.